own experience, I have rentals that I'm doing purely short-term rental, and those properties are making decent amount of money being short-term rented, right? And if I try to rent that property long-term lease, right, it's probably going to make on the paper 4 times less money than actual short-term rental.
Wow.
So every time I do the loan, or like special investment loans or the DSCR loans, I always work with a lender that they can take advantage of my short-term rentals. Again, my short-term rentals are under the LLC. They're showing on my taxes. The income is there, right? I did work with a couple of lenders. I tried, and they didn't want to even acknowledge my short-term rental. They were asking me for, I think I'm going to say correctly, 1007 appraisal for the rental appraisal.
Yes.
So we had to send the appraisal there for him to appraise how much would that home be rented if it's a long-term rental, and that's how I got the number.
Comparison.
Comparison. If I divide it by 12 months, basically it will be 4 times less if I rent short or a long-term rental comparing now to the short-term rental. Yes, short-term rentals, they have some ups and downs. There are some pros and cons comparing to the long-term rental. But if you're ready to handle the stress, it pays much more, especially if you're at some good location. Question about the USDA loans. USDA loans are mostly for the rural areas, right?
Yes.
For the farms, for example.
Exactly. So every house, like if you want to buy a house and you say, Asma, I want to get a USDA loan. So my first thing is to get to the USDA website, put that address in their website, if it qualifies or not. If it doesn't qualify, it doesn't qualify. If it qualifies, then it's a very good loan. I will just send you all the information, like whatever I need, and we will start the USDA loan. But it has a geographic limit.
And when it comes to the investment loans, I had some situations that they were, again, depending on credit score, right? 15% down is kind of the minimum for investment loan, and then it goes up depending of your history, credit score, and all that. That's correct, right?
No, actually now, during COVID, it has increased. The 20% is the minimum for investment, a regular loan. And if whatever I see, I don't know about the other lender, but I see when I put 20% as compared to 25%, it's always hitting me the pricing with 2% point. If so, whenever my clients are putting 20% down, the system is hitting them with two points fees as a points, right? So I tell them that you are paying 22% anyway, because you are paying extra 2% to the lender or for the rate. So why don't you put 25% down? No, very good rate and no fee.
Can you tell us what those points are? We hear those all the time. I explain to my clients all the time, but we tell them points. They're like, what are the points? And they're asking, are those fees that they see in their sheet, are they negotiable?
Yeah, points are the percentage of the loan. Like if a lender is asking you, hey, I'm giving you 6% rate, but there is a cost of 2 points. So 2 points mean the 2% of the loan amount. Like if you are getting a $300,000 loan, and if I'm charging you plus of the regular closing cost, 2 points for the rate, so it means that you are paying $6,000 extra for just the rate, and that's the point. And the lender is not getting that money, it's going to the secondary market for that rate, because it's illegal for the lenders to just charge anything for themselves.
Correct. So basically, they're paying those points so they can get a lower interest rate. If they don't want to pay those points, they're going to pay a little bit higher.
Exactly.
It's really based on how much cash available they have. If they have extra cash to pay for the points, sure, go ahead. If there is no extra cash, if they're tight with down payment, maybe they just accept a little bit higher interest rate and roll with that. It really depends from situation to situation.
Exactly. It's like I always tell them, it's like pay now or pay later. Because if they pay now, if they have money, so just pay now $6,000. Because if they are paying later, then it would be 3 times that they will be paying. So it all depends. And again, it's all about each scenario, each person, and their criteria and the guidelines and the scenarios.
One thing we didn't cover about FHA loan, the insurance, the mortgage insurance. So, or any other property. But if the down payment is lower than a certain percentage, then that PMI is mandatory, right?
Actually, for FHA loans, no matter how much you pay a down payment, there is an MI because it's backed by the government. But like a conventional loan, if a borrower pay less than 20%, then it's a mortgage insurance. But for FHA, even if a borrower is paying 50% down, 50, they are paying mortgage insurance. It's less. And as compared to conventional, the FHA have decreased their mortgage insurance from 0.755 to 0.50. So and a lot of time when I'm comparing the loans and mortgage insurance, FHA mortgage insurance with lower down payment is lower than a conventional loan with a 10% down payment. So it all depends.
Yeah. And only way for them to get rid of that mortgage insurance is for them to refinance through some other program. In my case, for example, that first home that I purchased with your help was a FHA loan. And honestly, I never did refinance because the interest rate, I think it was 3%. It was perfect timing. And I ended up selling that home actually last year for almost $200,000 more than I bought it. So it was a really good deal, and I never refinance. All other homes, I think I have one is still in 3s, but all others are like in 4s and 5s, and one is a 6. But that was the 3.0. It was a good time. Good time.
But again, I bought my own house that I'm sitting right now. It's in Vienna. I got a good deal, and I was paying 7% interest rate, but I did not care because that was a good deal. I got a house $250,000 less than the price. So if I would see that, or I would see 2%. And again, it depends how bigger the loan is. So that would be most. I had a small loan, so I didn't care that much.
About the loan size, before we go to the credit score and what's important for that, can you tell us something about jumbo loans? What are those big loans that people have to apply for if they want to buy multi-million-dollar house? Or what are the limits in Virginia? I think Virginia has higher limits because of Northern Virginia, but what are those jumbo loans?
So there are 3 categories of loans. So first, a regular loan, I think 875 in Northern Virginia, DC suburbs. That's a regular loan, conventional loan. Then it's a high balance loan from, I think, 875 to 1.1 or 1.18. And then it's a jumbo loan, the third category, above all these 2 limits. And jumbo loans are good because their rates are good. They're mostly because they're bigger loans, so their rates are good, but their guidelines is very strict. I just got a contract for 1.4 million, and I don't want to go to jumbo loans. And my client was saying, so why not? Because I was telling him that jumbo loans have post-closing 12 to 24 months of liquid or non-liquid post-closing reserve requirements. There's a lot of people, if they're buying a $2 million loan, they are putting $500,000 and $600,000 or $700,000 down. Then still they're going in the jumbo, but then they don't have any. They're putting everything in down just to keep the mortgage low, but then they don't have the post-closing reserves. So the guidelines for jumbo is pretty stricken. So there is a way that we could avoid it. That I do mostly of the time. And again, it's different for a different scenario. If they have 401k, 500k sitting there, or any non-liquid or asset, we could go jumbo very easily. But if they don't, then what I do, let's say I have a $1.3 million loan. So I would divide it into 2. I'll get the max for the high balance loan for 1.1, and then I'll do first and second loan to avoid the jumbo guidelines. So it's all how you know what you know and how could you do it. So jumbo loans are very good for a lot of people, but are not good for a lot of people. Like everything, it's not for everybody.
I see.
But there are ways to avoid jumbo.
I see. Well, end of the day, it comes to the buyer also to get a little bit educated what type of the loan is best for him or for them, not just believe anyone. And again, that's one of the reasons why we're doing this type of videos, is to educate future buyers, sellers too, so they know what they're dealing with. And based on that, what are the most important things that buyers should take in consideration when they're deciding which loan is for them? They should for sure be aware of their income, credit score. What else?
Income, credit score, their debts. 3 most important things is the credit score, and because the rate is based on the credit scores, and not just the credit score, debt to income ratio depends on their debts and income, and how much down payment they have, that depends on the loan to value. So all these factors are combined in a rate. It's not just like Somebody called me that, oh, I have 700 credit score. What's my rate? I don't know, because I don't know what your income is. I don't know what your debts are. So how do I know what the price is? So it's not one thing or another. It's a combination of the whole thing: the credits, their debts, their income, how long their employment history, and how much are they putting down.
In my case as well, when I was applying for the comps, I'm right now, this is my 10th, 11th year in the States. So I moved here 11 years ago. And my main issue back then was not the credit score rate, it was in 700s. Problem was the length of history hold.
Yeah.
So that was my main problem. But how important is the credit score? Is that the most important thing when it comes to the?
It is very important, but it's not the most important. The most important thing is income. Because a lot of people come to me and they have 780 score, 790 score, but their income wouldn't qualify. So they cannot get a loan. So even if they have 620 score, but their income is good, they can get this. They can get almost the same rate on FHA at least. So very little difference in the rate because of the credit scores, but a huge difference in the down payment and loan amount and income. So income, credit, and debts, and amount of money they have. It's a combination of all four things.
It's a
All four are
combination.
important and not one or the other.
The main thing people should understand, if they want to purchase the home, no matter the amount of money they get, they should be responsible with their financials. So that's the main thing. Even for buying a home or anything else, especially if they want to get a mortgage, you have to know your numbers. Like no matter if you make $10 an hour or $200 an hour, you have to know financials. People are mostly worried when they're working with lenders, if that lender are going to pull their credit multiple times, would their credit score get affected? Because they're scared when going to the car dealerships and the dealer pulls their credit through million banks, and then they just keep getting those hits on the credit, and then what happens? Their credit drops. So is that the same situation in the real estate world?
It was, but now, since I think starting of this year or last year, we are not pulling the credit, the hard credit. A lot of lenders are doing soft pull. So soft pull, we can get their credit report and their scores, but it's not a hard pull. So it's not a hard effect on the credit scores. And we can work it out with the soft pull until we get the contract. Once we got the contract, then we could put the hard scores and just put it underwriting. So it's not that anymore.
And which is the most important credit score? Which one is the most important one?
Actually, it's a combination of all three. It's a minimum score of 3. So Equifax, Experian, and TransUnion.
And like again, speaking from my personal experience, my credit score is a tiny bit lower now than my wife's credit score. Again, because I'm applying for so many loans, I'm doing flips and all that. However, when I was talking to some other lender a while ago, we were trying to get a better rate. I was like, let's do a joint borrow with me and my wife, because let's say my credit score is 680, her credit score is 760 or whatever. It doesn't really matter, right? Because you guys are always taking the credit score from the lowest credit score in the application.
Yes, because remember that it's the rates. Lender is lending you the money based on the I wouldn't say worst scenario, based on the risk evaluation. So the higher the risk, and again, I see a lot of people who are just doing everything good and paying off everything on time, but it's still somehow they don't have a good credit. It doesn't mean they're bad people, or they're not doing something. Life happens with everybody. So, but the lenders, it's just like some guideline that we have to follow the system. So they took the lowest rate just for the risk evaluation, and the higher the risk, the higher the rates.
I remember working with you that first time you gave me the guidance, how can I improve my credit score or whatever was happening, so we can get that debt to income ratio to be better and all that. So most of the time, those are like paying off the debt, right? Most of the time.
Yeah, or adding, not opening a new credit. Opening a new credit would never good for. Adding, if like you and your wife, if your credit scores are low because of the higher balances, I would assume it's nothing bad, but it's higher balances, right? So if your wife has 2 or 3 credit cards that with higher amount but zero balance, or like $10, $20, add your name on to those accounts. So those are not new credit cards. They're already open, but by adding your name onto that, all this data come on your credit report, and it's showing that you have, like now it's showing that you have $100,000 credit limit, but you are already using 75K. So your balance are higher, and but now adding that these three credit cards, if all combined is 60,000. So now you're $160,000 credit limit, and your balance is like what? Out of 160, 75K. So your credit scores will go up very high. I mean, very fast, like maybe 2 to 3 weeks, and then we can redo the credit report, and your credit scores will go high. A lot of times, even within the process of the loan, 30, 35 days, I do this for a few clients, and they add their name onto their spouses, sister, whoever is like as an authorized user. Then we pull the credit report, and the credit scores have just gone much better, and they got better rates.
I see. Is there such a thing as a rapid rescore or
Yes,
something?
rapid rescoring. That's what we do. Yeah.
Okay.
Yeah.
But no matter what, you kind of have to wait approximately 30 days for that new credit report to hit, no?
No. It's just like you have to see when they're reporting it. So as soon as you increase, that's what we do. Rapid scoring mostly do lenders do. I ask you to just add your name, and then within a week or so, I would ask you to just go to the website, create a login, and see if your names are showing on those credit cards. If showing them, send me the statement or snapshot, whatever. I'll send it to my credit team, and then they will do a rapid rescoring. So even if the lender would not even record or report that credit or credit cards onto your report, we are reporting it. So we are doing rapid rescoring, and then the scores will go up.
I see. And you just mentioned you guys are doing now the soft pull before you get the contract with the buyer.
Right.
So we come to that famous pre-approval. So I assume for that famous pre-approval, you're doing a soft pull, so you can see how much the buyer can qualify for, right? And then when they sign the contract and all that, then you get into the real numbers.
Okay.
How do you guys prevent? How deep you go into the information with that pre-approval, and what pre-approval actually is?
Yeah, soft pull are the same as a hard pull, but it just doesn't affect your credit scores. So we get all the data, and we would do it. And pre-qualification and pre-approval is a difference. It's just a small technical difference. Pre-qual is just like you call me and Asma, I have 780 credit score, I have a $300,000 income, my debts are only 50K, I have $20,000 down. So you gave me all 4 information: the down payment, the credit score, the income, and the debts. That's what we need. And I'll get you a pre-qualification. That's just a qualification. I have not checked your credit. I just take whatever you told me and send you those. And that doesn't mean anything, to be honest. If I'm a good lender and I know what I'm doing, I would never give you a pre-approval or pre-qualification or anything on paper with my name on it that you could go ahead and check out these houses, because that's nothing. So pre-approval, when I give you a pre-approval, 99.9%, I've never had any problem. And I check the credit scores. I say to them, hey, it's good, but you are serious. You're going to see a house, right? And if you like the house, you want to put a contract in. So why wouldn't I do a soft pull? Send me these documents. If you're self-employed, send me your tax return, 1099. That's it, pretty simple. And tell me how much money you have, and let me pull your credit. So I have all the data in. I'll send you a pre-approval. And I know, and even if I have to do a hard pull, that's good for 90 days. So for 3 months. So even if I do now and then you find a house next month, after 35 days, even I can use the same credit. I'm not pulling another credit report. So for me, I would never pre-qualify somebody, because that doesn't mean anything. So why would I do it? That's what you could do by yourself. Whatever you say that you tell to me, you just say that, oh, I can qualify for that much loan. I check income, credit, debts, and scores. And then I'll get them a pre-approval, and they go ahead and they can just write a contract, and we close. And we never had any problem.